Right, we've got a few more seconds to go before we strike over to the 9 o'clock. Good morning, everybody, and welcome to I think it's our 14th webinar we've been doing over the last 18 or so months since we got into the new normal of pandemic lifestyle. We welcome you all here today on today's discussion of hedge your bets and your portfolio. We have Murray Winkler, co-founder of Laurium Capital and a portfolio manager, and then also Matthew Pouncett, who's a co-portfolio manager and analyst within the team on financials. Thanks for joining us once again. You would have heard a little bit of music. We've tried to get that right today. No hiccups between that and sharing the presentation, fortunately. We are sharing today some views on hedge funds, and what we're going to do is, because of the composition of our audience that seems to be around half between those who are invested with hedge funds and those who are not, we're just going to spend a few minutes in the beginning doing a quick introduction, a 101 on some shorts and some details around them, and then we'll go into a bit more detail from there. Bit of housekeeping: please feel free to pop any questions you may have into the Q&A during the discussion, and we'll address those at the end. This is a 45-minute session. We try to get through the slides in half an hour and then leave 15 minutes for questions towards the end, which we're happy to address any of yours. What we did last time, which we thought was a bit of fun, was to introduce a secret word, or a word which we all use throughout the presentation. And the first one to pick up on that word, who pops it into the chat, sorry, not into the chat, into the Q&A, please, will be rewarded with a bottle of Laurium red wine at the end. So that's just to keep you all on your toes throughout the session. So it will be one word which all three of us say that may be slightly out of context or out of the ordinary. So let's see if you can pick up on that. And then, yeah, without further ado, we're going to kick on into it. The first thing to highlight is that we've just turned 13. So Laurium has become a teenager, which is very exciting. We did that on the 1st of this month. So congratulations to the whole team, to Murray and Gavin, the founders. We're pretty excited with the progress which the firm has made, and are really looking forward to the future. And thanks obviously to all our clients and everyone that supported us over the years. So without further ado, we're going to hand over to Murray, who's going to take us through the first few sets of slides.
Thanks, Mike, and good morning, everyone. And to reiterate what Mike said, thanks for all your support over the years. It's been a great 13 years so far. So on the hedge funds, really, if we can go to the next slide, Mike, I guess the first thing I'd like to say about hedge funds is, what is the difference? Now, the FSCA has a definition. A long-only fund, you go long. The differences of hedge funds per the definition is a hedge fund is able to go short. And the second thing in the definition is it's able to lever up its returns. Now, that means it can leverage up, or it can leverage the returns down. So it works both ways. So that's where the risk comes into it, and risk management. So if we just look on the left-hand side, the long-only fund. So basically, generally, if we take the South African universe, 100 stocks, you choose your best 30 stocks, broadly speaking, maybe more, but a concentrated portfolio, 25, 30 stocks, you choose those and you go long. That's all you do. If you want to change a portfolio, you need to sell a stock and buy another, and replace that with another long. The hedge funds, what you're able to do is you're able to, if you don't like a stock, you can go out, you can borrow the stock from someone, and you can actually sell the stock in anticipation that it will fall. So let's take an example, Discovery. We put in Discovery towards the end of last year. We thought the valuation was very full in our hedge funds. It's trading at about 150 Rand. Our view was that our fair value actually was around 120 at that stage. And what we did then is we borrowed the shares, we put a short on, and our bet was we will be able to buy that back at a lower price than 150. As it happens, it's worked quite well, because Discovery at the moment is trading actually below 120, and we have bought back quite a few of the shares. So we've made money on that. We made close to 20% by shorting. Now, long only couldn't benefit from that. So maybe if you put it into sort of an example, imagine you just bought a new tool set, and you've got a lot of tools in it, and your youngster goes in. You've suddenly got to fix something in the house. Not that I do that, but you go and get your toolbox, and all you see there is you've just got a spanner left. This is a long only guy. He goes to his toolbox. He's got the spanner. That's all he's got. Now, spanner, you can do a lot of things, but not that much. But it's a versatile tool, I guess. Then you go to the hedge fund guy. He goes there and he goes into his toolbox. Now, he's just luckier. He's got a few more tools left. And he's got the spanner, the screwdriver, and the hammer. So that's how you should think about a long only. What he's able to do, fairly limited. Hedge fund just can do a lot more. So that's a big thing. If we are able to hedge our risks out as well. So if we take an example, we've been very positive, the insurers, I guess, as a whole, Discovery being the exception on valuation. But if we take momentum, so in all our long only funds, we've run big positions in momentum this year. And that's done, I obviously only tell you the stories that go well, because we do have a lot of things we don't do well, but generally they go fairly reasonably well. But momentum this year, it's up some 23%, 24% since, if we just look year to date. So if we're long only, in our long only funds, we've made 23% on momentum year to date. In our hedge funds, we've had the momentum trade on, but we've also had a short Discovery. So we've picked up exactly the same amount of uplift from momentum. And at the same time, by being short Discovery, we have made 20% on that. And we reduce our risk by saying if we put 50 million rand long in momentum and 50 million rand short into Discovery, our market exposure is actually zero. So we don't have the beta of the market, we just have the individual stock. So we'd have zero market exposure. We'll look at that a little bit later. So that is also one of the things we're able to do. And if you get those right, you can actually generate very good returns. Some of the other stuff, I guess, is also just, if you're a hedge fund, you're able to be nimble. You can buy anything. You don't have to sell anything because you always have cash in your portfolio. So that's a big thing. Some of the myths out there, hedge funds are not regulated in a black box. Globally, that is very true. There are probably 9,000 hedge funds, very little regulation. South Africa is actually one of the highest regulated, is the most regulated of any hedge fund in the world. And that's through the FSCA and through the unit trust legislation, which happened in 2015. Hedge funds are high risk. That is 100% right. It depends on how you manage your risk. So globally, there's some hedge funds that have blown up. You always see those stories, but the top hedge funds manage risk extremely well. And in South Africa, there are risk limits for the retail investment funds, the RIFs. You cannot gear up too much, and concentration per stock is limited as well. So that's one of the things. Hedge funds don't add value after fees. Now, we all know that people worry hedge fund fees are high, which is right. They're higher than long only. On average, cash hurdle with 20% sharing above that. But you look at your returns net of cash, and Matthew will show some of the returns after cash, after fees, and they're pretty good. So net of fees, hedge funds in South Africa have done particularly well. If I take the top 5 biggest hedge funds over the last 13 years from when we started, including ourselves, net of fees have done better returns than the market, and at lower vol as well. Every single one of the top 5. Next one, Mike. Okay, so this is just for some of you that maybe aren't that familiar with hedge funds, how it works. So if you look at the blue, let's go a long only fund firstly. I've got 100 Rand to invest. I go and buy a basket of shares, and on the left-hand side, I go long. So I've got 100 long. if I move across to the net position, my net exposure to the market, then I fully invested 100% exposure to the market. So if I match the market, I go up in line with the market. If I don't match the market, if I go down, I go in line with the market, I go down. That's my net. My gross exposure, which we'll come to on the hedge fund side, is also 100. So my 100 is 100, 100. Now I decide I'm going into my hedge fund. So if we go to on the where the point is now A, where A is, I go and I buy 100 shares. I'll buy exactly the same shares and I go long. So that's step one. So I've got exactly the same exposure as a long only guy. Then I say, no, hang on, I really like I like these shares, and I've identified some shares that I don't like. That will be B. So if we go down to B and I say, let's take another 50 Rand. Let's borrow some shares and sell, let's assume it's Discovery plus a couple of other shares. So I go short 50 Rand. By selling the shares, I get 50 Rand cash back to myself, and I take that 50 Rand and I go and buy 50% more C of my longs I already have. So what it means is I have a portfolio that is 50% more on the long side than a long only, and I've offset that extra 50 with the 50 short. So effectively, it means if we move across to the net side, our net exposure is still to the market is still 100. So we have 100 exposure to the market. So we'll move, if our longs and shorts move in line with the market, we will go up and down with the market at 100, 1-for-1 ratio. But our gross, which is a definition, you take your longs plus your shorts, is actually 200. So we 2 times geared, and that's a gearing ratio that people refer to, 2 times geared. So if we get up, if our longs do better than our shorts, we're going to do substantially better than a long only fund. So that's what we strive to. And over time, if we look over the 13 years we've been around, that's what we have managed to do. So we'll look at that a bit further on. But that's just broadly to give a little bit of understanding there. So what are the risks out there in the hedge fund? The biggest risk is shorts are a dangerous thing, because if you spend 100, let's just assume you put 100 Rand in a stock and it really goes badly, a la Steinhoff, you're going to lose 95% of your money. That's it, gone. If you choose a short that does really well, let's assume you chose Google 5 years ago, and you shorted the stock, or Tesla. A lot of people were shorting Tesla, I suppose. I don't know how much Tesla's gone up, but at least 10, it's at least a 10 bagger. So if you shorted it and thought it's going down, it goes up 10 times. You are not going to lose 100%. You're going to lose 1,000%. And that is the danger of hedge funds. So what you need to do is your bet size on shorts need to be appropriately sized. You need to worry about liquidity, because liquidity is a big issue. And in our funds, we will never have more than 3 days trade in any one stock in our shorts. And generally, our shorts come from the top 80 market cap or top 80 liquid stocks in our market. So if we decide to buy back, you can buy back, and you don't get in a situation where there is a short squeeze. And then you also need to be wary of stocks that people borrow a lot, because there can be a recall, and that's when you get spikes in short. So that all comes into your risk management process, which how you identify good hedge funds is those have probably been around a long time. So sort of 10 years is a pretty decent, and we've got a lot of hedge funds in South Africa that have been around for longer than that, and the risk management has been pretty decent. Next slide, Mike. Okay, what we've got over here is a picture of our main long short fund, which has been going for 13 years. And what we show is at the bottom of the chart, we show our average net equity exposure. So relative to the market, we've been exposed on average 56. So if we have 100 million in our fund, 56 million is our net exposure to the market. So basically, you would expect us to go up and down. If we had no skill, we would go up and down in line with the market at a 0.56 over time. So that's step one. Now, if we've got skill, because we use leverage, we should be able to do a lot better. So then we come back to our gross number, which is the top line. And you can see that we've ranged from our average since we started our gross, our longs plus our shorts has been 140%. Now, the maximum we can go per Cisco regulations is 2 times gearing. So that's for a retail fund. So you see, we're pretty conservative, run at about 140. So to put that in what that actually means, we have effectively on average, so it's obviously varied over time, but on average, we've taken 100, if we've got 100 million, we've taken 100 million, we've bought 105 million longs, is what we've done. So we've been 105%, and we have shorted 35% of stocks. So that's basically the construct what we have of our hedge fund. And then we've managed that over time, and it has moved around. You can see our net exposure has been as low as 35 and as high as sort of 80% in the fund, but has averaged 56% of the market. We do run an aggressive fund, which takes more leverage, and the returns have been a lot higher, but you obviously have a bit more risk, and we'll see those numbers a bit later. So if we look at the hedge fund industry in South Africa, it's pretty disappointing, I must say. So when we started the business, my personal view was that this, and Gavin's as well, but the hedge fund industry in SA was going to grow quite rapidly. It's very small. It is 73 billion rand. It's actually almost nothing. And the top 10 funds run 60% of the hedge fund assets in South Africa. So very small. And if we just look at it, 49% of it is a long short strategies. There's some multi-strat and fixed income, but the bulk of the money is run long short equity, and a little bit of we do long short, market neutral, and aggressive basically. So what we did though, I mean, our assets under management now as a firm are 37 billion. After 4 years of being in the industry, we actually branched out into the long only space as well. Said we're doing all this work. This industry is not growing as much as it should. That's why we went into long only as well. But I mean, our hedge assets, we run 3 billion rand of hedge. So it's still very important to the business. And the returns, probably our aggressive hedge fund over time has been the best, probably the highest returns compounded over time, slightly better ahead of some of our other funds. Okay, bear in mind globally, I think one fact is globally, there is $3 trillion is what hedge funds is the global industry. So relative, South Africa just hasn't taken off. So why is that? What are the issues? So I think historically, everyone has said, no, they're the factors: transparency, regulation, access, liquidity. So what has happened on that front? Basically, there is very transparent reporting. Unit trusts, obviously, on regulation in 2015. It's exactly the same disclosure as a unit trust, and regulated on the position sizes, your gross numbers. So very transparent, as I say, the most transparent globally you will find. So that's all been sorted out. And then I guess the other thing, daily pricing. People want daily pricing, which globally there just is hardly any global daily pricing. But in SA, we have two of our funds are daily pricing, but that still hasn't helped. So there is a little bit of a myth there. I think if we look right now, there is some work in progress. One of the biggest stumbling blocks, and what Mike and Kim say to us, is that you're not an equity fund. Let's say our balance fund is not allowed to invest into a hedge fund. So we would like to take you're allowed to 2.5% could be invested in the hedge fund, in an individual hedge fund. 10% can be invested across the board into hedge funds, but the unit trusts do not allow for a balance fund to invest into a hedge fund, which we just think does not make sense at all. Board notice 90 is in progress. They're rewriting that. There's been a big push for that. I think it's going to take quite a while, but if that gets through, we think that makes a very big difference, that you can have a bit of an allocation to hedge in your balanced funds. And the other thing that's also quite difficult is for IFAs to sell the funds. They need the experience for a hedge license. And the problem is there are very few people that you need I think, what's it, Mark, is a 3 years training to work with someone.
Yeah, you need a KI to supervise you while you're in the process
for 3 years,
of acquiring it. And the problem is that there actually are very few KIs to go around that have the experience, and therefore it's sort of a chicken and egg. If you can't get the supervision, then you can't get the requirements.
Yeah, so those are two things, but really, is that going to substantially change it? It's still tiny, and relative to the way the returns it generates, we think there should be a lot more money in hedge anyway. Next slide. Mark, are you?
I have moved, Murray. You not see it?
Okay. Oh, there we go. Yeah, thanks. All right. So now we said globally there is. I thought you were going to have a question.
Not to worry. Carry on, Mary. Okay. We're running out of time of it.
Okay. No, cool. All right. Just the last thing then to say, globally, hedge funds, the allocations, there's 3 trillion in hedge funds globally. Now, all the big US endowments, how much money do they put into hedge funds? So if you look at Harvard, 36% of the allocation for the endowments for the university go into hedge funds. Brown University, Princeton, 25%, Yale, 22%. So more than 20% of the allocation goes into hedge funds globally. Now, if you look at the South African returns relative to international, they are way better as a whole. On average, significantly better than international returns. So it is quite amazing that the big universities, that's what they do. So that's anyway some food for thought. I think Matthew's now going to take you. There's one last one, sorry. Just on hedge. This is just looking on downside protection. On the left-hand side, we're looking at 2008. The red represents the Aussie, how much it fell by. And on average, the 3 worst months, July, September, and October, fell by between 9 and 11%. The industry, long shorts, fell max at any period in time by 4%. Market neutrals did nothing. And then if we look at the latest pandemic in 2020, market in Feb was down 10%, and in March 16. And the long short funds, which is the second bar there, were only down 5, and then the following month they were only down 9. So on risk management, they have consistently been protect your money on the downside and give you returns as good, if not better, than the market generally. Now I'll hand over to Matt.
Thanks, Murray. I'm just going to pop up a poll quickly, just for out of interest. The question is, what percentage would you allocate to hedge funds across your client's total portfolio? So bearing in mind those restrictions on the prudential investments, your retirements, up to 10% in a Reg 28 fund. But obviously beyond that, in the discretionary investments, you could go as much as you liked into a hedge fund for a client. So it'd be interesting to have your feedback. Matt, you can carry on.
Great, thanks, Mike. So we have 3 hedge funds at Laurium, 2 long shorts, the standard one on the left, and then a more aggressive version on the right, and then our market neutral. All 3 funds are run with the absolute return objective in mind. So you can see the CPI plus margin detail that we provided in the first column there. So if you think of these funds in terms of where they sit on a risk spectrum, the long short would effectively sit in the middle. As you move up that risk spectrum, we would move up to the aggressive, so a higher return objective, but with more risk appetite. The neutral would then be the reverse of that, so a lower return objective, but much tighter risk tolerance. I think it's important that, to note that all of these funds are effectively run in tandem. So the names in the long book will be similar across the funds. The names in the short books will be similar across the funds. So how we alter that risk reward dynamic between the 3 funds is by adjusting the net exposure and the gross exposure. So Murray mentioned earlier about the long short, that net number being around 55% over time. The aggressive, we would ratchet that up. So the net sits at about 80% plus on average. And we do that by upsizing long names. For the neutral, as the name suggests, we have pretty much, zero exposure to the market. That's typically run at 15% or lower net exposure. And you do that by upsizing shorts and downsizing longs. So that's kind of how we get that risk dynamic right. We are an SA-focused hedge fund, so we see our opportunity set as that which is listed on the JSE, and our universe effectively is an equally weighted universe across the JSE market spectrum. So, what do we mean by equally weighted? Stock number 80 in terms of market cap has the same chance as being sized the same as stock number 5 in terms of market cap. That would differ from, let's say, long-only managers, which will typically gravitate towards the benchmark weightings and the relative indices. So obviously, fund performance over the long term is what's important. We'll elaborate on that in a bit. We have provided our year-to-date and 12-month numbers, being fully cognizant that those are flattered somewhat by the crash in the prior year. But I think the point here is that we've actually participated quite meaningfully in the recovery, despite running fairly moderate net exposure across our 3 funds. Mike, you can tab to the next slide.
And all those performances are net of fees.
Right, yeah, sure. Right, so I think this and the next slide are the important ones. So what we've done here is we've shown those net returns of our neutral and the long short since their inception dates, and we've compared those returns against various major benchmarks such as the general equity market. That's on the y-axis. What we've also included here is standard deviation or volatility. That's on the x-axis. And what you can see here is that effectively we've achieved higher returns than the general equity market. But because we're running those low net exposures, we've done it by utilizing significantly less volatility. So the long shorts had, just shy of only 2/3 the vol of the general equity market, and the market neutral has had, just shy of 1/3 of the volatility of the general equity market. So this is the same dynamic, but here we've just included our aggressive fund. So it's the little diamond in the top right quadrant. So here we've utilized a little bit more vol than a general equity market, or a little bit more risk budget than the equity market, but the returns achieved have been substantially higher. So the point here in the context of an asset allocation fund or a balanced fund is that by allocating to, let's say, more moderate funds, such as our long short, you can effectively replicate equity return, but using the same, but using a lower risk budget, or by taking slightly more risk, you can get substantially higher returns if you allocate to, let's say, a more aggressive fund. So I think that's the key message in these 2 slides. Right, so these examples are kind of bringing to life, Murray spoke earlier about the toolbox. I think this is giving some real life example as to how we do that. So the first example is what we'd call a fundamental short. So this is where we've identified a company that we think, will produce a negative return over time, either because of unsustainably high valuation or because we think, it has financial metrics that are likely to deteriorate. So this is a good example of a group or a basket of property shares that we went short in 2017 and 2018. You'll remember during the 2010 years, from 2010 to about 2017, the property market in SA did particularly well in the listed space. And that was driven very much by these companies paying very, very high distributions. So the market shifted its focus to net asset value and chased these very high dividend yields. But effectively, underpinning a lot of these high dividend yields was unsustainable financial engineering. So, the most simple one was the companies would just simply take out debt and pay that debt out as a distribution. The market would price that distribution as sustainable, but effectively it was not backed by income, it was backed by debt. So the result was that come sort of 2017, you had a basket of property stocks trading significantly above their net asset values on, very unsustainable distributions. And we saw that as an opportunity to go short. We didn't quite hit the top of that 700 number. We were probably short more close to the 650 when we initiated, but that trade generated substantial returns in our 2018 year. So this is a long purchase of MTN, and I suppose that an obvious question could be, why is this a hedge fund trade? And I think what we're trying to get across here is how much faster and how much more nimble a hedge fund is than a long-only manager, because you have ready access to cash. So because we sit on 50% net exposure, we always have an available cash pile. A long-only fund, to buy, they have to sell, so the trade becomes a lot more cumbersome. And in this trading in particular, there was a very short window. So in March 2020, of course, we were in the middle of the COVID crash. All shares fell, but MTN in particular actually fell more. And this was because there was technical selling on the share. So there was a large shareholder that was leveraged into the MTN shareholding, and the banks were foreclosing, and they were effectively selling that stock to make margin. So there's a very short window where the share price just reached an absolute extreme, and you needed to be able to buy it very quickly. I think another point is that there's always an opportunity cost in a long-only fund. So for a long-only fund to buy MTN, they would have had to have sold another share. And in hindsight, all stocks were fairly valued at March 2020. In our case, we can just add MTN. We don't have to sell any other shares. Next slide. Thanks, Mike. Right, so this is what we'd call a special situations trade. And it's really a function of the fact that we can be fairly nimble in terms of what instruments we hold. So we're not bucketed into only holding a particular type of instrument. And in the SA context, because we don't have a dedicated special situations industry or a high yield debt industry, we often find opportunities like this fall through the cracks and actually can produce very good alpha. So we'll all remember the Steinhoff crash of 2017. At the same time that the ordinary share was falling, there was a listed preference share which also fell heavily, which kind of makes intuitive sense. Steinhoff had lots of debt, preference shares are junior to debt, but there was a bit of a kink here, and Steinhoff is effectively two groups. So there's a European group, which is where all the debt was issued out of and where all the fraud occurred. And then there's a South African group, which effectively holds Pepkor and is a relatively clean balance sheet. There's not much debt. And the kink here was that these preference shares were actually issued out of that SA subsidiary. So they had structural seniority and were very highly asset backed. So we purchased it around the 40 Rand level. The share actually was suspended for a bit because of financial reporting delays by Steinhoff. You could still trade the share, the preference share, but just you couldn't do it through a JSE broker. But even throughout that period, because there was so much asset value and so much cash flow, we received our dividends throughout. So we received about 27 Rand in dividends. And of course, as a kind of realization of the strong asset base, came through, the share has obviously appreciated. What's interesting is that we actually still hold the share across our hedge funds. We still think it looks very interesting. The view is that Steinhoff is likely to be wound up at some point, and on liquidation, we're effectively owed 100 Rand for these preference shares. Mike, next one. Right, so this is what we call a rump trade. Just to throw more jargon at you, a rump trade refers to the instance where you have a listed holding company that in turn owns other listed companies as well as unlisted companies. The rump refers to that implied valuation of the unlisted component, and it also captures aspects such as a holding company discount. So the most famous one, or rather most infamous one on the JSE, is the Naspers 10-cent rump, which effect is actually negative. So Naspers market cap is below their value in 10 cent, and that's because of a very large discount that the market is attributing to Naspers. But this is a lesser known rump, which is RMI, Rand Merchant Insurance, which owns stakes in Discovery and Momentum, which are listed, and then unlisted stakes in Outsurance and Hastings. What the chart on the right is showing is that rump valuation and implied valuation has just steadily fallen over the last 5 years. So that's the market taking a dimmer view of Outsurance, as well as taking a view that, an emergence of a holding company discount has come through. But we're actually very positive on Outsurance. It's one of the best financial services company in South Africa. We're very positive on its prospects. And we also think that the discount at the moment is too significant. So what we can do is we can concentrate our exposure just to that rump, just to that Outsurance and to that discount. And we do that by neutralizing the Discovery and Momentum exposure through shorting out those shares. And obviously, a long-only fund can't replicate that. Okay, Mike, that's it from me.
Super. Thanks, Matt. I'm just going to share the results quickly of our last poll. Very interestingly, a lot of you looking to allocate sort of between 5 and 10% of your overall client exposure to hedge funds, and then encouragingly, quite a few too also looking at the 10 to 20 and over 20%, which is good to hear. So hopefully we'll see future support in the hedge fund space. So just questions have come through, and we will address now as to how you could access our hedge funds in the South African marketplace. As you can see on the left side there, we have been able to get our hedge funds onto several of the lists. And just to break down what that table means, if there's a D in the column, it means that it's daily traded and daily liquidity. So you can use it, you could go into it sort of intra-month. Whereas if there's an M, it means that it's monthly traded. So you'll see that our aggressive hedge fund, which is a QIF, we've mentioned that word once or twice in the presentation, is a qualified investor hedge fund. That means you'll have a minimum investment of R1 million, and you need to be quite an astute investor to go into that. Whereas a retail investor fund, anyone can go into that. Obviously, it's best to seek advice before looking to go in, but you can go in, and the minimums vary between the different funds. So our minimums on our two hedge funds, the long, short, and the market neutral, is 250,000, and you can go in via those various platforms which we've highlighted there. So that takes us towards the end. On the right side, I've just got those performance metrics as we illustrate on the scatter plots. We've got through the rump of the slides there now, so we're happy to address some of the questions that you may have. I see we've got quite a few on the Q&A and one or two on the chat. I think a good question to start with from one of our supporters, Doug, is what is the appropriate investment horizon for the long short fund? So maybe for you, Murray.
Yeah, thanks, Doug. I'd say that you should think very much as an equity fund. I mean, basically the same. So, I mean, really 3 to 5 years. I mean, I think it's a long-term investment. You do have equity exposure. So think of it as being in a long-only fund, same time horizons. So 3 to 5.
Great. And then have you had to deal with any short squeezes? Well, you've been waiting for an idea to come through. How do you mitigate these kind of risks?
Okay, short squeezes. I mean, I guess globally there've been a lot. Locally, I guess and Matt can probably add to it, but the one I remember is Mondi, where we had a situation where we were short the stock and we mitigated the risks by putting a derivative on with one of the banks. And that was quite fortunate because we were worried that this thing could spike. And it ended up spiking. It did actually spike, but we are protected because we could keep the stock. It spiked for literally a couple of weeks. Everyone was scrambling to get it back. And I can't remember the exact number because it's quite a few years ago. It must have gone up over a week, 50 to 70%. So it was pretty scary, but we were convinced it would come back. So everyone is trying to get script back for a corporate action, and the stock just went up, 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 and then it came right back down. So that's probably the biggest one. Matt, I don't know if you can think any. None of them have been huge. Very good results come out, and you can see a stock take off. And if you've got 3 days to trade, generally highly unlikely to lose more than 15% in that situation. I don't know if Matt, if you can think in more recent ones. Really, it hasn't been anything.
Nothing on our market. Obviously, you know, in the US, you had all the GameStop saga. I think it's important to answer the question around sort of the risk mitigation. So, you know, it's about sizing shorts appropriately. So our highest short position will be will be less than half, let's say, our longest long position. So you size appropriately, and then we monitor short interest. So short interest is the percentage of shares in issue that are out on borrow. So the higher that number, obviously, you know, the more risk of a squeeze. So that's something that we get from brokers that, you know, we collate to ensure that we're not short any stock that is heavily shorted by our peers. And then the third one is obviously liquidity. So you monitor the liquidity of the share. You know, we've got a general sort of rule of thumb, you know, a 1% short position, we need to be able to cover that within 3 days of trade. And if it's a 3% or higher short position, we need to be able to cover that within 1 day of trade. So it's around the mitigation of your short book to effectively sort of mitigate any kind of short squeeze pressure.
Thanks, Matt. Kim's just reminding me, I know a lot of you know Kim well, just to remind you that you can come directly into our hedge funds. You can go to our website, the forms are available, and that would be via our Manco, the Prescient. To the next question. This is probably very interesting to a lot of you. It's just, what are our expectations on the JSE after China's actions on Tencent? Will it hurt the JSE badly? To you, Murray.
Okay, I think firstly it's hurt it quite badly. Fortunately, a lot of other shares are going up, so it hasn't. I mean, if we look at Process, I don't know the exact number now because I see Tencent is up about sort of 4% today, but I guess Process is probably down some 20-25% year to date, and Naspers probably, I guess, closer sort of to 10. So there's still a lot of uncertainty and risk out there. Our view on the valuations is that the stock is probably overreacting. So we've actually been adding, the last week we've been adding. We've actually also been switching because there's a big corporate event happening with with you having to tender your Naspers shares to get processed. That happens actually end of this week. And we've actually been switching, probably done R1 billion trade across all our funds in the last 2 days, switching some of our Naspers to process because we think relative in the next month with flows of funds, that is where you'll make money. So that's sort of, it's more of a shorter term thing. I think that if we look out over 12 to 24 months, we'll find that Naspers is going to bounce back. So we think this risk premium's gone up a lot, but we still think it fundamentally looks very good. But obviously it's a big underperformer, probably over the last 12 months. But right now, look, we could still be a little bit more downside. But we think the valuations, Naspers is at a more than 50% discount to the underlyings. So you are protected a lot. There's big margin of safety. So we think it still looks, longer term, still looks very attractive. You just might have short-term noise for a while.
Thanks, Murray. And then a question from Barend. Have the poor returns of the SA market over the last few years helped or hindered your hedge fund returns? Similarly, have the good performance of quality investment style versus value style helped or hindered your hedge fund returns? For you, Murray.
For me, okay. I thought you were going to give that to Matt.
Okay, Matt, you're welcome to take it if you want.
Sure, I can take it. So I think the first point we'll make is that we are, a long bias fund. So, as Murray explained, we sort of have net exposure of 50% and above. So we always will be somewhat impacted and influenced by general market returns. The second point I'll make is that, because we sort of invest across the JSE spectrum, we will tend to have larger exposure to, let's say, mid and small cap funds than, for example, if you compare that to the equity benchmarks, which obviously heavily weights to large caps. So we generally will have some equity exposure, and some of that will come from domestic mid and small caps. So the last 4 or 5 years, that space in particular has seen very, very poor returns. We've sort of run, analysis on this. If you look over the last 5 years, most shares on the JSE have produced a negative return. So that has impacted our let's say, sort of more medium-term performance. We don't sort of box ourselves into a distinct, valuation style, but we certainly do have more of a value tilt, in our investment process and philosophy. We're not sort of momentum traders. We generally have, fundamental valuations, and that sort of guides, where we invest. So again, that probably as a factor has hindered, let's say, medium-term performance, because as we know globally, kind of momentum and growth has certainly, trumped value. So yeah, I think that opens the question mark.
Super. I think that's all we've got time for. So just to address the elephant in the room as to who's called out the correct secret word through the presentation, that goes to one of our regular attendees, Mark Liddy, who's done very well. He's picked up on Rump, which was mentioned. So congratulations to Mark. I think there'll be a bottle of red on its way to you. But thank you to everybody for joining us today. I think we're bang on time at 9:45 now. We hope that today has offered some insights into the way in which we run hedge funds and given you a bit of an idea as to how to access our funds. And we look forward to your support in the future. And thanks to all the clients who've also dialed in today. Hopefully we haven't gone into much of the detail of the underlying investments within the funds, but I think if nothing else, it's given you a better understanding of the portfolios. So thank you to everybody, and thanks to our panelists. And to those questions which weren't answered in the session, we'll get back to you outside of this. But thank you very much and have a good week further.
Thanks, everyone.
Thank you very much.
Cheers.